Okay, we're broadcasting.
Welcome, everybody.
Thank you, Hector. Welcome you as well.
In Swedish, it's välkommen. Nice and easy.
America.
Well, you're right.
Lindsay, you have the questions, right?
Yep. Okay. So the first question is, what value would you place on Right Now Technologies?
I have no idea. I don't know why, but I have trouble when they say put a value on a company, because especially on this one, I don't know. I feel like when they do numbers, but they give you options to go for, so it's not like different values, I guess. And I couldn't figure it out. He couldn't figure it out either.
You couldn't.
I think there's a lot of different ways to value a company. So here's my question. Then,
Okay.
Do we know what the sales are for the last 12 months for Right Now Technologies?
Yeah.
Okay. So sometimes people look at the sales and it's 2 times sales, or maybe they say it's 5 times gross margin, or so I didn't really see anywhere like how they wanted us to value it.
Yeah, it's so vague. That's the only problem with some of these, like figuring out the number stuff. It's so vague, and it's like, well, we don't even learn how to do that in this class. I can't remember everything from all the other classes.
Yeah. So, it says right here, but by December 2003, Right Now's annual revenues had grown to over 35 million. But does it tell us what their profit margin is?
No, all I did was I just looked at their total revenue. Is that what I did?
Okay.
I just pulled total revenue, and then I calculated Salesforce and Right Now, and then I did the projected growth like at 55%, because he wanted to be between 50 and 99% growth each year. But I have no idea if I'm right, because I may have been off on my numbers, the first ones. But I thought that it might be sitting around 54 million, but for 2004. But I don't know for sure.
Okay. Mine was close, because usually the funny thing is each industry is different. So if you're going to go buy a business, let's just say, or you're going to get it valued, a lot of this depends on the type of industry, right? So I don't know what the standard is. If you're going to go buy a carpet cleaning business, they have a certain way that they value those types of businesses, which, we're not really schooled in that here. But so I just kind of went conservative and said, all right, well, 2013 was, 2003 was at 35 million. And so I just doubled that. So I said, well, I'd value it at 70 million. I don't know if that's right, but that's what I did.
Explain how you got that one more time really fast.
Yeah, like I said, there's like a lot of different ways to value this stuff,
yeah.
I just looked at December. So this is like it's like right in the beginning. It talks about the values. Unless I didn't see, was there a 2014 value? Basically, I took the most recent analyzed sales for the value of the company.
Okay, so why did you double it though?
Just based on other valuation. It's nothing I learned in this class, so okay,
it's like
kind of like
I had a
magic.
Yeah, I had a hard time, I guess, figuring it out. But now, like sitting here thinking about it, is isn't, I guess, technically the value of a company considered the market capitalization in a sense is worth.
Yeah.
So even, I guess I don't mean to say this harshly, but we're not given enough data to do that, are we? Because we're not given the number of shares or the net income.
Right. When I Googled like how to figure out the value of a company, you know, they like gave.
I just did that.
Did you? Yeah, they gave like 3 different ways you could, and that's why I did the total revenue, because they said, you know, you could take total revenue, you could take whatever else, you know, and so.
Okay.
Yeah,
Yeah.
like here's the one. It says how to evaluate a company. The method used extensively by financial analysts involves projecting a company's future cash flows and discounting them at some rate to arrive at their value in present dollars. The discount rate applies to startups is typically steep, from 30% to 60%. So, you know, we could look at, sorry, Jorge, did you want to say something?
Oh no, it's me, Hector. So yeah, I was looking for.
Oh, Hector. Sorry, Hector.
It's okay. The same problem. I felt that we didn't have enough data, but basically what I tried to do is to take the profit and trying to do something with it. Since I found out that having a good positive cash flow could really help you with know where the company is. And it seems like technologies right now, it says that they always been like up and down, up and down. Like when they first go publicly, they did pretty bad with calculating their shares and getting money to their cost. So one thing that I was thinking is either when to do that, because once you value a company whenever it's at its top, like performing pretty well, of course it's logic that it's going to have a greater value, because the current cash flow, just like you read right now. So basically cash flow, I think, will be the most accurate thing for us to look up for this case.
Yeah.
That's a good point.
All right, so we all have kind of some answers then of what we value the company at, whether we're crazy or not. But I guess what's the next question?
Yeah, next question. Yeah, let's just move on.
If you guys aren't satisfied with that, that's cool. We can keep talking about it. But
No, I think we're good. Okay. It says, please provide a range of values rather than a single number. How did you come to this conclusion? We pretty much just talked about that, right? Yep. We did.
Pretty much, because we all had a range.
Yep. Okay, it says, if Greg's investors seek a 30 to 50% internal rate of return, what exit value will they expect?
$1 billion.
Well, you know, they're offering what, 50 million or something like that. And so if you even just do it by 40%, it's a $70 million value, you know, so that's at least what I did. I don't know if that's even right.
Yeah, that sounds good to me too. Sounds great. I love it. I'm sold.
Sounds pretty good.
Say that again one more time. You broke out just a little bit, Lindsay.
No, yeah. Okay, so when I looked up like how to, I of course Googled again, how to figure out an exit value for a company. And it said, yeah, it said like, you know, because in the case study it says they want like a 30 to 50% internal rate of return. So they are off, the venture firm, or if they did acquisition, was offering 50 million for the company. And so it's like, oh, okay, so maybe, you know, in a year or two, a few times it, I just did 1 year by 40, you know, 50 million by 40%. and it goes up to 70 million or whatever. And so I was like, oh yeah, then that's what they'll get. It'll be a value of 70 million after a year. But
so that's the
yeah.
IRR.
Yeah. But I don't know if that's right. I can't remember half the crap we do in classes. So
I know this is all for like, yeah,
it's like
IRR is like internal rate of return, your IRR. Profitability metric used by business projects are likely to yield the greatest return per dollar of capital investment. Though it is closely related to the net present value, the IRR reflects anticipated gains as a percentage of the initial investment rather than as a net dollar amount. So do we know what the initial investment was?
Wasn't 1 billion? Sorry, wait, never mind.
I think
I was going to say if they're looking to sell it for $60-70 million and started with $1 billion, they're not doing so hot.
No, I think because he just started out of his own money, and has been growing it. But I think the acquisition that's in question is they're offering him $50 million.
Yeah, because it says he funded right now with $5,000 of his own money. And then by the end of '97, company had booked about $20,000, and then by 2003, revenues grew to over 35. So, but that's my dilemma is the IRR is the internal rate of review, right, or rate of
return.
Return, yeah. Mm-hmm. So it's like it's percentage of the initial. I mean, he's making a ton of money based off of a $5,000 initial investment.
Yeah, for sure.
But maybe I'm just looking at it wrong, and I'm not understanding the question.
Another thing that it's kind of tricky is that the companies, when they try to get as much value as possible, they exaggerate on the growth projections, or how they think the market is going to grow. And to me, they saying that it was going to grow like 425 million. I don't know. It seemed kind of too much. I don't remember the rate. I think they were going to say it was like 40 or 35%. And so that kind of was kind of sketchy for me to really believe if they said that they growth that for reals, or just to give it more value to the company.
Yeah, that's a good point.
Yeah, I agree. I think that probably sometimes they do say, oh yeah, it's going to grow like this much, and it may not grow as much as their highest value. I agree with that, Hector. That's a good point.
Yeah.
I mean, there's a lot of things that you could do to underreport or overreport. You could say, oh, all of our expenses are lower than what they actually are. So you're underreporting, but still, that totally messes with the financials of company. So if their projections were to grow to that number that you just talked about, and they sold their company for, what was it, 70 million?
No, 50.
50 million. I mean, but if they can grow it to revenues in a few years of, I'm trying to find where that was at in the case. Or Hector, you just mentioned it. Was it like 425 million?
Yes.
I mean, your internal rate of review, your IRR is going to be way better to hold onto all the, the company and grow it internally than to just sell it. But if they want that
to do.
Yeah. Okay, perfect.
Oh, no, go ahead. Sorry, I didn't mean to cut you off.
No, I'm like, done. Next.
Well, no, that's the next question is which do we all think he should do based on the analysis that we all came to with all our numbers?
Oh, I think they should just continue growing it. There's no sense to try to take it public yet because they can grow so much more.
Yeah, they need to grow organically. They get a better revenue. But too is that, you know, he's creating more jobs. He's doing this and that. Going public would possibly probably ruin them. And I totally agree. If they went public, they're going to be ruined quicker. And they tank, in my opinion. I hate to say it that way, but they tank.
I mean, a lot of this just kind of depends on the personal preference, you know, of the entrepreneurs. Like, are they like, well, I'm burned out of doing all this. I just want to take my, you know, I started with $5,000 and I can sell it and walk away with 20 million and have a nice day. And then I can go backpacking and do all that and just be done with it. So some of these valuations that we talk about, that some of that stuff might not matter depending on the personal goals of the people.
Yeah, good point.
I guess all we can say is, well, if we're just looking at it from a financial, and that's the thing, decisions aren't always just financial. There's a lot of emotional investment. And in this case, anyway, sorry, I'm blabbing, but
no, that's a good point.
It's an interesting thing about all these case studies, I think.
There's pros and cons to each one. I mean, if he acquisitions everything, he has money in his pockets in the bank. But then it's going to come down to, oh, I'm bored again, let's start another business. And possibly lose it all. So, I mean, like you said, it's personal preference.
Yeah.
Hector, you have anything else? I don't want to cut you off.
No, yeah, that's fine.
You're good. Yeah, I totally agree. And I actually looked up what he ended up doing
on Google.
Yay!
And he kept it and sold it. No, I think went public and then sold it to Oracle in 2011 for like 1.3 billion. So he did good.
He made a better revenue off of it.
Yeah, he did really good.
But even to grow it to that point, you know, I mean, he had to. Yeah, so maybe he went public with it, but if he still had 51% of the shares, then he still had control to sell the whole company back to to another public company. I don't know if Oracle's private or not. I know they're huge, so I'm assuming they're publicly traded.
Yeah, they're publicly traded.
Yeah. So, I mean, that doesn't mean that, you know, if you sold the business for how much? What did you say? 1.1 billion.
1.3.
1.3. I mean, he didn't walk away with all that money himself because they had venture capital along the way, and his shares were diluted and all that fun stuff. But
yeah,
to say the least.
Yeah, for sure. But still, selling for that much money, you get a pretty huge pocket change.
I just hope I get into a point where I can negotiate with somebody selling my company for that amount of money.
Oh my gosh, I can't even imagine.
Sell a company for more than $1. I'd be happy.
I mean, it's an interesting thing to think about, If you could sell, in 5 years, you could sell your company and boom, you're a millionaire. Would you just say, sweet, see ya, let's do it. Now I'm going to not do anything for the rest of my life. Or would you say, you know what? No, I'm not down with being a millionaire. I want to be a billionaire and do it for another 10 years. And just, that takes a lot of guts.
Yeah.
It's just an interesting thought. At what point do you say, it's like a gambler, right? You're like, okay, I'm good. I'm up. Let's get it. I'm done. I'm done with the stress.
Yeah. Are you talking in general or this case?
Just in general. But in this case, too, think of us. If we want to get to that point where we have our own businesses, when do you know when to pack it up? And sell it and be done with it. That's got to be hard. Yeah. Yes. $10 million is a lot of money. 50 million. I don't know. Maybe the guy walked away with 500 million. With this percentage when they sold the Oracle. I don't know what that is, but it's all just a lot. But how much would we have to stomach? Would we have the stomach to do something like that when when one of our ideas becomes big and, you know, we're growing like crazy, would we say, hey, I'm out at 10 million, or would we keep trying to go? Anyway, sorry, just a thought. It's
No.
interesting to think about that stuff to me.
For sure. Well, no, and I think it has everything with what you said earlier, like the emotional investment. You know, like if someone's still passionate about doing the company and stuff, I think for sure they'd be like, yeah, I'm all in, like, let's keep going. But but for like, as part of the case, he already sold the company, and he said like he was like totally living a comfortable lifestyle, had like tons of money, you know, so I think for him, I think it was like, yeah, I'll just keep going because he was bored, you know.
Yeah, well, yeah, exactly. You know, he's like, well, I just want to keep. Yeah, it's interesting. I don't know. I try to put myself there. It's like, part of me just thinks like, sell it for 10 million, peace out. You know, I could live a good life and not do a whole lot. But other people, they want more and more and more and more. I mean, I don't know if I ever. Well, I can tell you, I don't see myself becoming a CEO of a Fortune 500 company. You know, like, oh, I just want to run all these things. Like if I had a little business where I was making, you know, having gross profit of 10 grand a month, I'd be like, I'm feeling pretty good about myself. Like I'd be happy with that.
Yeah, totally.
So I don't know. I just try to look at these case studies and like apply it to my life. Like, well, if I was in this situation, what would I do?
Yeah. Yeah, for sure.
Okay,
well,
sorry, I digress.
No, I think you're totally on a good point. Well, and just like one other side note, it's like you never really hear about the milestones and other things that go into these deals of when other companies acquire these smaller companies, you know, because if they don't hit target milestones or certain things, like you get like even more payout as the years go on. You know what I mean? So anyway, it's not only just the initial, you know, it's like they're getting so much money.
No, like for example, there's in the industry that I work in, which is mobile imaging, so portable X-ray and ultrasounds. So we'll go to like a skilled nursing facility or like a nursing home, and we'll do X-rays on elderly, frail patients or people that are recovering from, you know, hip and knee surgery, that kind of stuff. And there's big companies out there that they're always buying up these little guys, but part of their purchasing agreement is it's kind of stepped, like you said. So, hey, we're going to buy you guys for 10 million, but we're only going to give you 2 million up front. They need to make sure that they're not buying this company that, you know, the value goes in half within a year because people don't like that they just got bought out by a big company, you know. But if it's strong, then they can get the, you know, all of the money. So there's a lot of different ways to buy different companies to protect your risk.
Yeah, that's true.
Anyway.
Yeah.
Yeah.
All right. Well, and that's it. There's only 4 questions.
I am hitting stop unless someone else has something to say.
Nope.
No, that's everything.
Amen.